Hi, everyone. I hope you're really well. I'm Pamela Hastings and welcome you to another Barometer webcast. During this webcast, we will provide a review of current market and economic conditions. As always, I encourage questions and participation via the chat. You can email me at phastings@barometercapital.ca. We will address your questions at the end of the webcast. With that, I turn the conversation over to our President and Chief Investment Strategist, David Burrows. Good afternoon, David.
Hey, Pam, it's good to see you here in Toronto.
Thank you.
I'm coming to you from Barometer head office worldwide at one university today. We actually had the whole team in the office this afternoon for the first time, I think, since the end of March. So we had a very productive afternoon, and I think that we'll do that about once a month. But at the same time, we got to continue to distance. So another week's gone by. We are now into the earnings period, and there's some things to take away from that. And what I'd like to do is just quickly sort of go from a top-down perspective as to what we see going on and maybe how positioning is changing. So as we've been talking about, we continue to be in a structural bull market in stocks. Hard to believe given the news flow. Hard to believe given the fact that we're in a global pandemic and earnings and revenues for most companies have been hit pretty hard. But the S&P has slowly been recovering off the lows from the end of March. The S&P has been in a range since about the beginning of June, around June the 8th, chopped back and forth. We've been slightly above that range, but it is a market of sort of haves and have-nots. The last time we spoke, we talked about the fact that underneath the surface of the index, the percent of companies performing well has been falling. So this is a market that has been narrowing over the last few weeks. We came to a point in the US where we had close to 80% of companies participating in the rally. But since the beginning of June, that percentage has been falling. And as of today, about 50% of stocks are in uptrends. If you take the lens back a little bit further, interesting enough, about 80% of the companies in the S&P 500 are underperforming the index, which means that a few companies, a few of the very large companies, are carrying the day. As of this week, 23% of the S&P was the top 6 companies, and we all know who those horsemen are. If you were to look at it versus the NASDAQ 100, those 6 companies make up 55% of that index. But we need to know what's happening under the surface, because if breadth continues to narrow, we know it tends to be eventually you see some weakness in the stronger stocks, unless those trends start to reverse. So we watch that closely. As of this week, if we take all US stocks, 50% of stocks are in uptrends. That has been sort of slowly declining. However, the leading characters in this play continue to perform well. So a few things that we have to keep in mind. First of all, sentiment has become quite bullish. Lots of people sitting at home trading stocks, and we know that private investors are quite optimistic as we sit right now, despite the news. If we look at put-call ratio, or the number of people buying calls versus buying puts, put buying or betting that the market is going lower is at a 20-year low. So it means that people are pretty fully invested and definitely are betting on higher prices. What else have we learned in the last little while? Well, insiders are a little more cautious. Insiders have been sellers 5-to-1 versus insider buyers. And you can see historically when these numbers get higher, market can pull back somewhat. So we have been focusing on leading sectors. We've been being careful about being in the groups that have been underperforming. And so it's a fairly concentrated portfolio. So things that we learned over the course of the week. Okay. Things got a little bit better on the short-term indicators. Percent of stocks trading above their 50-day moving average improved. Percent of stocks trading with positive weekly price momentum improved. Percent of stocks trading above their 150-day moving average, that improved. If we look around the world, we continue to see weakness in breadth in Europe, Latin America, Asia Pacific, including Japan, India, and Shanghai. So it's very much a NASDAQ-centric market, and the focus has been in sectors which we've been talking about, technology and healthcare and golds. So here we are now into earnings, and the expectations are pretty low. Companies have been very careful about giving guidance. As we came into the quarter, consensus was that earnings for the S&P would be down 43%. Now that's not something new. People have been building in numbers that were going to be weak. The company's been very careful about giving guidance, and so as a result, probably the numbers are too low, and it's likely that we're going to see them come in a little higher. Expectations for revenue was down 11%. So those are expectations. And so versus what has been the historical path over the course of the year, certainly this is an anomaly. Now, the question is, how do they actually come in versus expectation? As we sit today, we're about 15% through the reporting period. So 74 out of 500 companies have reported. First of all, in general, revenues have come in about 3.5% ahead of estimate, but earnings have come in 18% ahead of estimate. So that can help explain why it is that the market has been hanging in as well as it has. Now, there have been three key drivers we've been watching. One of them has been expectations for earnings and how those might come out. Two, we were looking at what kind of liquidity is being provided to the market by the central banks and policymakers by way of monetary and fiscal stimulus. That has continued. Another very large aid package out of the EU, $850 billion, came yesterday, and there's expectation of another $1 trillion plus program to come out of the US. So that liquidity continues to be there in the marketplace. The third thing is vaccines. And then we've heard a spate of vaccine deals this week. Companies are moving forward from phase 2 to phase 3. There are lots of various vaccines in the works, and there is optimism around the fact that there could be a vaccine by the end of the year. The question is, how well does phase 3 go? And that's all focused around safety in large numbers. And then how quickly can they ramp up to produce? And as I think you know, US government and governments around the world are funding simultaneous buildup of manufacturing capacity to go along with the various sets of testing going on for various compounds. And ultimately, I think the hope is that there is something by year end, and this liquidity is aimed at bridging the gap to get us to the point where there is a vaccine. And so obviously there's lots of questions surrounding that. So here are some other things that happened during the week. We talked last week about the fact that there was a very large reversal in the NASDAQ about 2 weeks ago, a very large up day and then a significant reversal. And some of these companies have reported. Netflix came out following that, reported, came in a little bit late and had an impact on the stock. If we look at Amazon, Amazon is set to report over the next week, has recouped part of what was given up in that past week, but is yet to be able to do that. Tesla, similar, is going to report this evening. A very large up day about 10 days ago, has been consolidating since then. So the leadership in the market has remained firm, but it has not made progress. The NASDAQ is now about 2 weeks in this consolidation. So we look to see how the earnings come in and whether these stocks can continue to perform. Breadth for the NASDAQ has been contracting. So we have removed a few positions and taken profits just to be somewhat less offensive going through this period. We recognize there's lots of risks. So other key things that are taking place, US dollar has continued to weaken versus world currencies. With the printing presses ramped up, they are monetizing some of the debt, and this puts a bid into hard assets. So this has been very positive for our significant exposure to gold and precious metals. Gold prices hit new highs today and have been followed along by gold stocks. That's the large senior producers, the junior producers as well. And in fact, probably an even bigger impact on silver companies, which are up 29% over the last 44 days. So the themes continue to be technology and healthcare and golds. On the day that the NASDAQ bounced this week after the pullback last week, while technology was up, all 8 sectors beyond technology were down. So we need to see the market rally broaden out. And before we put new positions on, we'll look to see that start to take place. This week, the banks were slightly better, energy was slightly better, industrials were slightly better. We know they are under-owned, but we need to see that fall through. All of those are helped somewhat by a weaker US dollar. So the picture remains the same. Long-term bullish, short-term a little bit cautious. We're into July and August. There can often be pullbacks in this period. So we're being careful with our exposure. In our equity and long short fund, which have had just a tremendous 2 quarters, are sitting up between 20 and 25% on the year, well ahead of indices. Balanced portfolios performing well. Income portfolio way outperforming the income dividend universe, which is still down 25%. It's down 6 to 7. In our macro portfolio, we do have set up very defensively, which would be a counter move to a weak market. So that fund is set up to be quite defensive and take advantage of some weakness should we see it. So in the near term, as we get new news, we'll pass it along. But Pam, I want to keep it concise. We're here in the middle of summer, and we're going to hear a lot more on earnings over the next week, which we can come back and add lots of color. If there's any questions, happy to answer them.
Dave, we have one question. Just sometimes we talk about choppiness in the summer, and just wondering if you could elaborate on that.
Well, look, seasonally, July and August can set up for some weakness. When you come through the first half of the year, analysts have to do a gut check on their estimates. Now, this year, they've come into the second quarter earnings period with very conservative numbers. But rightly so, companies are giving very little guidance. And companies are giving very little guidance because they have very little information. And there's so many different paths that we could follow. So often, when you get through the second quarter, analysts start taking down their numbers for the remainder of the year if they can't get more clarity. We're sitting here in a situation where the US is not following the path of the rest of the world. The cases in the US rising much more rapidly and probably has been handled in a not nearly as a positive way. And so, there's going to continue to be news flow. So we are all addicted to the stimulus that central banks and governments are proposing. We're all hopeful of speedy development of a vaccine or several vaccines and get them into circulation, and those are positives. But the reality is there's a lot of businesses that are struggling. Now, as I think we have focused in the businesses actually that have been helped by this pandemic, where their business models have been accelerated by 2 to 3 years. Companies like Amazon, companies like the video game companies, where it's just expanded their audience. And we've not made a bet on the companies that would benefit should the reopening go more smoothly than expected. But there's a lot of those companies in the index. And so should the news flow get more difficult, that could add chop to the market. The way I come at it is that I say if breadth is narrowing, meaning fewer and fewer stocks are behaving well, we have to be a little bit cautious. And that could be 5%, it could be 10%. We would take that as it comes. But as it is right now, what it means for us is we are not being overly aggressive. We have taken some profits on a few positions that have behaved extremely well, and we'll take it day by day. But there can be pullbacks at any time. Just probably the summertime is where you can see it a little bit more frequently.
Thanks so much, Dave. That concludes our questions for today.
Okay, that's great. If anybody has anything that they would like to speak directly to one of our counselors about, or if they'd like me to jump on the phone and talk about anything in particular, certainly happy to do that. And we'll update you as to the progress on earnings and other issues as we go along. And should additional issues arrive, we'll put out something in between these Wednesday calls. Oh, and there's the Tesla number has just come out. It looks as though it must be a good one. Stock's up 5%. That will be helpful to markets. Thanks, everybody. Talk soon.
Thanks, Dave. Take care. Bye, everyone.